So yes, I'd like to just first begin by echoing Luan's sentiments here, and thank you all once again for joining us today on this snowy day. And I also want to thank another special shout out to Deborah and the whole Thomson Reuters team. It's been such an honor for me to have the opportunity to really work closely with them putting this event together over the last couple of weeks. I do a lot of these events. And it never ceases to amaze me how they grow from just this mere concept, into this incredible production, really, and this room full of energy and Wall Street veterans and shakers and movers and industry leaders and pioneers, and we even have members of the media coming today. And it's so fulfilling when you just really start to see the events coming together and shaping up like this. This event really has a special significance, and that's because I believe that this is really the event that is going to set the stage for crowdfinance to redefine Wall Street and usher us into a new period of economic prosperity, not just for financial institutions that are too big to fail, but for all kinds of businesses of all sizes, for investors of all sizes, and for underwriters of all sizes. And I thought that I would just take a few minutes before we really kick off the day and just sort of summarize, this concept of crowdfinance and, really illustrate how it is currently impacting our financial markets, and also just take you through a little bit of a journey, basically showing you some of the events that led us here and how those events are really shaping where we're going. Now, because there's so much misconception in the marketplace about crowdfinance and what exactly crowdfinance is, I usually start by illustrating what crowdfinance is not. Now, you guys may have seen this. It was a little cartoon that was in the New Yorker this past summer, and it basically depicts these two panhandlers asking for money on the street, and the caption reads, "Remember, we're not begging, we're crowdfunding." And while it's a cute little cartoon, and it went out great for a cartoon and kind of amusing, the truth is this has absolutely nothing whatsoever to do with crowdfinance. So what is crowdfinance? Crowdfinance is really not much different than conventional finance. Just like conventional finance, it can be broken down into three different subcategories. You have your consumer finance, your corporate finance, your public finance. Just like conventional finance, crowdfinance can be structured as debt, it could be structured as equity. The only difference between crowdfinance and conventional finance is that in crowdfinance, instead of capital coming from big financial institutions and government entities, it's raised directly from the crowd, or what I like to call we the people. And in fact, crowdfinance is simply the same underlying principle that built America in the first place, and it enabled it to grow from a vast farmland to the greatest economic power to the greatest economic superpower in the history of the world with the strongest middle class. And that doctrine is simply this: it's allowing its citizens to freely invest in the innovation and ingenuity of its fellow citizens. That's it. That is nothing to fear. That is all that crowdfinance is. So to frame the day, we're going to walk you to, we're going to take a kind of a little quick journey through, as I said, some of the events that led us here and how they're shaping our markets to where we're headed. Starting 1971, NASDAQ, nothing more than a quotation system, emerges onto the scene and begins trading with 2,500 over-the-counter companies, bringing transparency and order to a very fragmented marketplace. That same year, Intel invents the microprocessor and ushers us into the computer age. The same year they invent the microprocessor, they also go public. Believe that or not, they go public at a $58 million valuation, raise $8 million on their IPO. My old alma mater, Unterberg-Tobin, actually was the lead underwriter in Intel. During this time period, NASDAQ invents the modern IPO, and it basically sets the stage for other innovative companies like Intel to have the opportunity to tap into the public markets, to raise capital, to innovate, and to basically create products that go on to change the world. Companies like Apple. Apple goes public in 1980. Apple generates more capital than any other IPO since Ford Motor. But you know what's really significant about Apple's IPO? The regulators in the state of Massachusetts actually banned Apple's IPO, deeming it too risky for Massachusetts investors. And people are saying, now there are people out there saying crowdfunding, it's so risky. So was Apple apparently back in 1980. I personally think that people should be allowed to determine what their own risk tolerance is, but that's a whole other story. Microsoft goes public in 1986 at a $500 million valuation. They did not go public with a handful of underwriters like LinkedIn did or what the companies that you see going public today. They went public with 116 different underwriters. 116 different underwriters that had a whole ecosystem of support to support that company trading in the public markets. And they had small cap analysts, institutional and retail salespeople to support the stock, market makers, traders. That's how this was all successful. And to tell you, 99% of Microsoft's appreciation was realized not before it went public, but after its IPO, and it was realized by the investing public. It was all of us. We got to participate in that appreciation. Then 1990s, the internet comes onto the scene and basically starts to really democratize financial services. Company Quote.com in 1993 is founded. That they basically, similar to NASDAQ, just providing, instead of quotation to the financial institutions or to the financial services providers, they're basically providing quotes to the public through the internet. And they basically lay the groundwork for financial services to move online and really usher us into this whole period of the online brokerage world. 1996. Spring Street Brewing Company, the makers of wit beer, do something incredibly revolutionary. They use the internet to raise capital. We are so fortunate we have Andy Klein with us, pioneer in the space, first to raise capital over the internet and really leads us to where we are today. Then we move into the late 90s. NASDAQ went from that little nothing of a Quotron machine to the biggest stock market by dollar volume by 1999. Then NASDAQ moves into decimalization. We all know that had devastating effects on the small cap market. Dave Wield, former vice chairman of NASDAQ, is going to be here later talking about that. 2006, something really interesting starts happening. People begin lending other people money over the internet, complete strangers. And basically a new industry is born. It's the birth of P2P and online lending. And today we have with us pioneers and industry leaders in that space. We have Prosper, Ron Suber, head of institutional sales, is going to be here. Peter Renton, founder of Lend Academy, Funding Circle. We've got Cabbage. We've got some great companies here to kind of tell you about how P2P and online lending revolutionizing the debt markets. Then come back to 2008. The world is ending, the financial crisis. And, banks stop lending. And what is the government's answer to the solution to the financial crisis? Ooh, tighter regulations. That'll help. Well, too bad. The only thing that really did was favor the larger institutions and help larger institutions get even larger at the expense of small businesses and retail investors. But you know what? Even though during this time of crisis, inventors are still inventing. Companies, they're still innovating or trying to go out there and innovate. And we still have, we still have great companies being born, and we have new industries like social media rising. And companies born during this period like Facebook, for example, a company that went on to completely change the world and change the way we communicate. In 2010, Facebook is valued at a $15 billion valuation. Of course, that's considered too early and small to go public. Think about Intel going public at a $58 million valuation. So Facebook, basically, Lou Kerner, who's one of the who's actually the first social media analyst on Wall Street, writes a research report. And basically, he meets with the Facebook team and says, wow, this is a $100 billion company. Writes this research report valuing Facebook at $100 billion. And the demand for Facebook stock, even though it's private, it just explodes. And that really is the birth of private company secondary platforms like Second Market and SharesPost. They start to gain momentum. 2011. Pabst Blue Ribbon Beer is basically selling its company for $300 million. Two beer drinkers, probably sitting around playing quarters, drinking some beer, Pabst Blue Ribbon Beer fans, said, dude, we could buy this company. Why don't we just get a bunch of people that also like this beer to chip in? And funny, Andy, another beer company sets to revolutionize the market. So why don't we get all our friends to chip in and buy this beer company? So they go online and they see how many other Pabst Blue Ribbon fans are out there. They end up raising $200 million before the SEC steps in and says, no, that's not going to happen. That's completely illegal. But there's a man named Patrick McHenry, congressman down in North Carolina. He's holding the Pabst Blue Ribbon beer there. He actually gets wind of that campaign and he says, why is this illegal? And basically introduces legislation to basically legalize securities-based crowdfunding. 2011, Crowdnetic is formed by leaders in financial data, pioneers in the space. Same people that helped build Quote.com and democratize the public markets, now bringing it to the private markets, doing the same exact thing NASDAQ did in 1971. Crowdnetic is basically bringing private offering data to the general public. So for the first time in history, people have access to really what is going on in the private markets. Investment bankers, even hedge funds, you want to know what's trending, what's hot in the private market. That information was never available before, and now it is. At the same time, I founded NowStreet and started doing conferences just like this to introduce these rising asset classes to Wall Street. Of course, we did not have a space like this. We basically started off with probably about 30 people over cocktails. And it's grown tremendously over the years. 2012, Jobs Act signed into law. Could you believe it? Something actually gets done in Washington. A month later, Facebook goes public, or what my friends like to call the faceplant IPO. Facebook's fiasco basically demonstrates how the public markets are so completely broken and have become nothing more than an exit strategy for the financially privileged. 2013, we actually broke new ground in 2013. The nation's very first unaccredited equities crowdfunding capital raise was completed. A company that raised the money, you're going to meet them here later, Bohemian Guitars. Spark Market, it was all done through the intrastate exemption. Spark Market facilitated the transaction. You're going to hear their story a little later on this morning. In September 23rd, finally, the SEC lifts the ban on general solicitation, and that basically paves the way for new types of offerings and new types of structures for companies to go out and raise capital. And basically, through that, we're able to see a new offering and a new asset class called PIPERs, which are private issuers publicly raising. And we're going to talk about that on the first panel. A couple of weeks after that happened, Crowdnetic actually launched our data feed on Dow Jones Market Watch. So now what we've basically done was we launched this. NASDAQ did it in 1971 with 2,500 over-the-counter companies. We did it with Dow Jones Market on Dow Jones Market Watch with 2,000 companies. And basically everybody, investors across the globe, have an opportunity to see real-time and understand real-time private offering data. So now a little bit about that's where we've been and here's where we're headed. This is the reimagination of capital formation. This is the future. This is what's going to happen. This is how companies are basically going to grow up in the future or now. You start with an idea. maybe it's the greatest idea since sliced bread, maybe it's a big flop. But you don't have to go and go into credit card debt or raise money from friends and family that'll probably never speak to you again with an unproven idea. You could actually go out, test the market. Go to a Peer Backers. You'll meet Sally later on, founder of Peer Backers, or Kickstarter, Indiegogo, Rocket Hub, where you have an opportunity to basically do reward-based crowdfunding or test out your product, gauge the consumer demand. And not only that, but as you're doing this, you're establishing a customer base, you're building brand awareness, you're cultivating relationships with customers and future investors. Now, let's say that the idea fails, it's a really unsuccessful campaign. Okay, you know what? No money's lost. Go back to the drawing board, perfect it, tweak it, start over again, launch a new product. But say it is successful. Maybe you get to the next stage, and now you're ready for a more formal kind of round of financing. Maybe Title III crowdfunding, once it becomes legal, is for you. You want to raise a couple of $100,000. Or maybe it's you want to reach out to your local community, and maybe interstate crowdfunding is more appropriate for your business. But it's another opportunity to increase your building brand awareness, increase your customer base, and then you start converting some of your customers into investors. Now, let's say you get a little further down the road, company's growing, you want to raise a couple of $1 million, maybe you want to do a PIPER here. Here you have the opportunity again. You're strengthening your customer base. You're increasing your investor base. Now you're also attracting Wall Street attention. Now, let's say maybe you're more established. You want to do some debt financing. Maybe this is the time to turn to P2P. Now, as you kind of grow, now you get to this point where you're getting pretty big, but you're not quite ready to go public. You're not quite ready for an M&A. But you want to give some early shareholders some liquidity. Well, we're seeing, and we're going to talk a lot about this afternoon, especially we have Steve Wallman, founder of Folio, is going to talk a little bit about how the secondary markets are developing. But here's an opportunity to not only go out there and again, continue building the brand, attracting more customers and investors, but you also have an opportunity to really test out the market for your stock. And while you're giving early shareholders an exit, they're now taking that fresh money and injecting it back into the system. Now, let's say the company is ready for an IPO. At this point, you basically have a shareholder base, your own shareholder base. You have a customer base. You don't need Goldman Sachs to do your IPO. Maybe at this point, you maybe want to do a self-underwriting and do something through media shares, who you're going to meet later on today as well, G. Massey. Or maybe this is when we see the actual, resurrection of those small cap underwriters that made the markets great in the 80s and 90s, like my old firm, C. Unterberg Tobin, and the H&Qs and the Robbie Stevens and the Montgomerys and the Alex Browns. And now, let's say the company gets to a point that they're the greatest company in the whole freaking world. They're a large cap company trading on NASDAQ, and they want to launch a new product. Well, you know what? They don't have to go back at this point and go to their balance sheet or go and into the market and try and raise more capital for it, for an unproven idea or product. They could basically go back to reward-based crowdfunding, test it out again, test the waters, gauge the market, gauge the demand, and if it then basically move on. And what this is going to do, this is going to breed more efficient companies, and it's going to foster more productive businesses. And this basically is the future of capital formation. And because I always like to end these things on an optimistic note, I thought I'd conclude with this quote by Ernest Hemingway, because I believe that it applies as much to Wall Street as it applies in our own personal lives. Yes, our markets may be broken, but we're stronger in the places that we've been broken. And I will tell you, crowdfinance will fix our markets, and it will ensure that they come back better, that they come back more vibrant, more democratic, stronger and better than ever before. Because our children and our grandchildren deserve to inherit a functioning financial system, and that, my friends, is what today is really all about. So thank you very much.